So in this video today, we are going to talk about Chapter 13 bankruptcy and how to buy yourself out of the bankruptcy with a cash out refinance. So stay tuned for more information. My name is David Zai. I'm with the Zai Mortgage Team. What is a Chapter 13 bankruptcy? Chapter 13 bankruptcy is when you file into bankruptcy, you actually have a payment plan. So with the payment plan, on the bankruptcy, it is going to require you to have a trustee oversee the bankruptcy, and you file a payment plan. And typically those payment plans are going to be between 3 and 7 years for everything to be paid off. And then after everything is paid off, then you could go through and discharge the bankruptcy. Whereas a Chapter 7 bankruptcy it's a bankruptcy that you file, and after you file it, after a certain period of time, all of the debts are kind of removed, and that's it. You're washed of it, but it's 2 years before you can buy a home again. Here's the importance. You got to understand the difference, and we have to understand the refinance guidelines. So when you're making these monthly payments on the Chapter 13 bankruptcy, you've obviously faced some sort of hardship that has made it to where a refinance or a purchase at the time of filing the bankruptcy, you were not eligible for it. What the guidelines say is this, okay? And this is only going to be applicable to a VA and an FHA loan. The guidelines basically say that when you file a bankruptcy and you're in Chapter 13, that you can, with the trustee permission, buy or do a cash out refinance to pay off the bankruptcy after you get trustee permission and you've made 12 consecutive months of payments and you haven't had any lates. The benefits of this is that you can buy yourself out of the bankruptcy up front. You're not having to wait for the bankruptcy to go through. You're actually just able to buy it off up front and be out of it and not have to be on a payment plan, and to have it show up as a bankruptcy on your credit report. The waiting period, like I said, it is 12 months after it's been filed and you have trustee permission. The major factor that's involved in this is when you file a bankruptcy, you have to keep this in mind. And I like to say it as if like teaching my kids, right? When my kids were really little, we used to have those little outlet plugs that went into a light socket, and it prevented the kids from sticking their little fingers inside the light socket and shocking themselves. Well, we have to look at a bankruptcy like that, okay? You stick your finger inside the light socket and you zap yourself and you're like, oh, that's really painful. I don't ever want to do it again. So when you do a Chapter 13 bankruptcy, we know that you've had a period of time where you stuck your finger inside that light socket and, it's hurt so much that you're not going to go back to that well again and stick your finger inside the light socket and zap yourself. So that's where we do not want to see any additional lates, especially on your mortgage payments, especially on any outstanding new debts that you've assumed, and especially on that bankruptcy, because at this point, the trustee is the person that's kind of overlooking your payment plan, and they're wanting to make sure that, you have followed the rules and you have been paying everything on time. You've got approved or you've been approved to be able to refinance or purchase the home. If you have had lates, or especially an installment loan late, which is a auto loan, any personal loans, anything that's not mortgage related, it's a secured loan, then you will have a problem with applying for a loan again, because once again, you may not have filed another bankruptcy, but you have gone late, and the FHA guidelines state that, installment loans up to 2 in the last 12 months is a no-no, and it's a manual downgrade. That brings me to my next point: automated approval and manual approval. So an automated approval is when we put all the information into the file. We verified all of your documents, income, assets, and liabilities. And based on that verification, we see that everything looks good. And we run it through the automated underwriting system. And as long as the underwriter approves all the information that we put in, then we're going to have findings that come out that says either approve eligible or refer eligible or ineligible. Approve eligible means it's good. It can sail through as long as we meet the set of guidelines that are in the approval, then we're good. We check off all the income, assets, and liabilities. If it's a manual underwrite, and let's just say it's a refer eligible, then we're going to have some manual underwriting guidelines. An underwriter actually has to go in, review everything. If they have any additional questions on top of what the automated underwriting findings came out with. Let's say there's a question on your employment or multiple employments, or there's questions on any deposits that you may have in your bank statements. Then an underwriter actually has to go in and sign off on the loan saying that they've reviewed everything and to the best of their knowledge, everything is okay. Okay. That is a little more difficult. That is definitely something that, has more hoops, and there are going to be compensating factors that are going to be needed in order to get the loan approved. And there's guidelines, which we'll post down below, that say what those are. Okay, so for instance, if your debt to income ratio is the traditional, 31 on the front end and 43 on the back end, then you probably don't have any compensating factors. However, if you have higher ratios where your housing expense exceeds, let's say 44%, and it goes to 45, and then your back end total ratio exceeds like 49, then you're gonna have to have multiple compensating factors. And those compensating factors are the following, right? We may have alternative income that's not being used as a compensating factor, but we have that additional income coming in. You may have a decrease in your housing payment or only just a slight increase in your housing payment. That's good. Let's say you've been paying rent. Make sure you always document your rental payments. And then, probably the biggest compensating factor is cash reserves. So we always talk about income, assets, and liabilities, right? In terms of your assets, we want to see that you have saved the most amount of money that you can. And saving the most amount of money is going to, after your down payment and or closing costs, you're going to have multiple months of reserves left over. So let's just say your housing payment is $2,000 a month. And let's just say after down payment and closing costs, you have $12,000 left. That's 6 months of reserves, okay? Not saying that you do need 6 months of reserves, but that is the gold standard. Typically, cash reserves would be like 2 to 3 months, and that would be a compensating factor. And sometimes there's multiple compensating factors. There's residual income, which we can get into after all expenses and everything are paid off, how much is left over. And then finally, there's like maybe a very limited debt that you've had over a period of time. And maybe you just had 1 or 2 instances where you may have had lates that are more recent that have affected it. However, we have a letter of explanation that can kind of explain, hey, the only reason that all of this happened maybe was because of illness, death. You have a good letter of explanation as to why you had those lates in the past. When you're using the cash out to buy out the Chapter 13 bankruptcy, it is going to provide you a bunch of benefits. So the first benefit is you're not going to have to be under this Chapter 13 repayment plan for a longer period of time. One of the things that happened most recently is, home values have increased significantly. And with the increase of home values, that's given us the ability to take that equity that we have left over now and take the cash out following the FHA guidelines, and you had good payment history, and using that to get out of a 5-year or 7-year repayment. You're cutting that 5 to 7 years into a 1-year payback. You're going to have to pay it back anyways, so you may as well just consolidate all of your debts all into one. So it's really beneficial to go in and buy out your Chapter 13 bankruptcy early. And we're seeing this happen more and more. I would say a pretty big percentage of our customers that we talk to every single day have some sort of financial burden, whether it be a bankruptcy, a foreclosure, a short sale, lates on installment loans. And, as housing prices and, inflation kind of happens and rates remain high, we really want to look at the blended rate of all of your debts that you have. Okay, so what I mean by that is when we're looking at the interest rates of your loan, let's just say right now you have a 4% interest rate on your loan, and I'm telling you, if we do a cash out refinance, we're probably going to look at a 6%. You may immediately balk just thinking about that, right? However, if we look at the interest rate of all of your loans that you have combined, let's just say your installment loans, you have like 11% on those, like a car loan right now. It's really high. You may have some really high interest rate credit cards. You may still have that 4% interest on your current mortgage. And then you have the Chapter 13 bankruptcy payback. When you add all of that together, if the blended rate exceeds the normal interest rate that you currently have, and you can just be under one payment, that's a 30-year payment, it makes sense. It makes sense to pay off the bankruptcy all up front. So it's really important that you're working with a very experienced loan officer when it comes to this, because these guidelines can be misinterpreted. These guidelines are very important to know because, when we're submitting a loan into underwriting, we are basically your attorney. And that's the way you can think about it, right? We're going to be your attorney. The underwriter is going to be the judge of the loan, and our processors are the paralegals, where we get everything together and they sort it all together and put it a really nice package. And combined with us, the loan officer, we're going up there and we're presenting your case saying, this is why we feel like our client is worthy of this refinance. I know we talked about a lot on this. However, a Chapter 13 bankruptcy, there is hope. There are ways that we can lower everything and make it all happen. My name is David Zai. I'm with the Zai Mortgage Team, powered by Nexa Mortgage, and we can be reached at 757-478-8493, and I look forward to talking to you about this. Thanks. Bye.